Good evening, everyone. Welcome to the EY India webcast, Decoding the Union Budget 2026-27. We are joined by an esteemed panel of industry and EY speakers today. I would now like to welcome Sameer Gupta, National Tax Leader, EY India, to start the session. Thank you for joining us, Sameer. Over to you.
Thank you very much. Greetings, everyone, and a very warm welcome to EY's Budget Day session. A quick round of introductions before we get going with the content. Firstly, I'm very pleased to share that we have with us Gopal Mahadevan. Gopal is on the board of directors of Ashok Leyland, Invesco Mutual, and other group companies of the Ashok Leyland Group. Over 35 years of experience in the finance domain, Gopal has built a diverse career spanning various sectors, including manufacturing, internet services, project companies, and financial services. And he's contributed to various organizations successfully: Thermax, Amara Raja Batteries, SIFI, Sanmar Group, and TTK, and has received various recognitions, including Best CFO Awards from ICAI, IMA, and CNBC TV 18. Thank you so much for joining us, Gopal. And we are also joined by my EY colleagues, Dr. DK Srivastav, who's our Chief Policy Advisor. We have Jayesh Sangvi, who's our Senior Direct Tax Partner, and Uday, who's our National Indirect Tax Leader. So let's get started. You can move to the next slide, please. As a backdrop to the budget, we've seen that the global economy continued to face strong headwinds, whether it was the geopolitical issues that continued to persist, or whether it was the trade supplies which were disrupted due to supply chain disruptions, or the control on critical exports by certain economies which impeded global growth. We did see that from a global economy point of view, it did show some resilience, and we had a growth of almost 3.3%. We saw investment surging, especially in technology and AI. And even while that is true, the debate on AI investments not generating expected returns is on. In the midst of all of this, India continued to be a bright spot. It's the fastest growing large economy. The structural reforms of the government continued on the reforms bandwagon. We've seen how the bold structural reforms of GST were introduced in September 25, as well as the transformative labor codes just after that. To deal with some of the global trade challenges, FTAs are the norm with EU, UK, and New Zealand. And this is going to set the course for trade expansion, as we have more than half a dozen FTAs which are currently in negotiation. Despite all the challenges, the government has been agile in its decision making. And as a backdrop, the government did not lose sight of trying to keep to its fiscal target of 4.4%. Let's move to the next slide. From an economic survey point of view, which was just released a couple of days back, the growth has been projected to be between 6.8 to 7.2% for FY27. This reflects the very favorable macroeconomic environment, and this is characterized by strong consumption, low inflation, as well as increasing share of gross capital formation. Some of the strategic priorities which the economic survey did call out about how India can become an indispensable part of certain key global value chains. Looking at China to South Korea to Vietnam, the focus on managing clusters has been called out. There was also a focus asked about creating a national inputs cost reduction strategy to deal with how Indian companies can be far more competitive by bringing in a reduction on costs of raw materials, intermediates, energy, as well as logistics. And from a fiscal sustainability point of view, any financial indiscipline from the states was called out as something that would increase the sovereign cost of borrowing. On the tax reform side, the economic survey did spend some time on that. And the shift was in strategy in terms of moving towards a trust-based, tech-enabled governance model. We've seen the success of e-way bills under GST, and therefore the focus really was on how this could be a facilitator for logistics. Clearly, from a GST perspective, the digitization of the technology systems is something that has worked very well for the success of GST. And there is now a call out for using that digitization from a tax administration point of view for direct taxes as well. This was very heartening to see because as EY, we have propagated digitization of direct tax systems where we have made suggestions on the introduction of APIs in interfacing between taxpayers as well as the tax administration with CBDT. We've also made suggestions on how TDS reporting can be much better if all reporting is done on the basis of a common identifier such as an e-invoice. And this will do away with the copious amount of reconciliation that needs to happen at times. And lastly, looking at how the online refunds can be brought on to build more trust with the taxpayers. The economic survey also in the context of imports has called for an alignment between transfer pricing, which generally deals with overpricing, and customs, which deals with under-invoicing. And lastly, and this will be debated and talked much about during our webcast session, data centers and cloud hosting. The economic survey called out the requirement to have much greater tax clarity and thereby building tax confidence for large foreign enterprises committing large amounts of capital in the context of data centers. So with that, let's move to some of the macro fiscal considerations. And for that, let me bring in Dr. Srivastav to speak through the maths over here. Dr. Srivastav, over to you.
Thank you, Samir. Thank you very much. Greetings to all the participants. From a growth perspective, I would like to begin by acknowledging that India executed one of the smartest post-COVID recovery among major global economies. As depicted here on the left-hand side, you can see that the real GDP growth after the COVID contraction actually averaged has been in the range of 6.5 to 9.7%. In FY26, according to the first advanced estimates, it has touched a level of 7.4%. At the same time, we recognize that the nominal GDP growth has been coming down over the years. And in fact, in this secular decline, the 7.4% real GDP growth has been accompanied by a level of nominal GDP growth which is only 8%. That has an implication for the budget magnitudes because all the budget magnitudes are in nominal terms. So we'll work the implications out as we go along. But we also recognize that India's growth performance so far, particularly in FY26, has been very balanced both from the demand side and from the supply side. Now, on the demand side, the growth sectors have been private final consumption expenditure, showing a growth of 7% as depicted in the last column of that chart, of the table. And then we look at the performance of GFCF, which stands for investment, which is even higher at 7.8%. That means that India's growth has been driven by consumption demand and even more so by investment demand. In that investment demand, government's own capital expansion has been very important. We will see that as we go along. Now, in terms of the prospects for FY27 growth, the economic survey gives us some idea. Now, it says that for FY26-27, the range of growth, can you move to the next slide, please? Yeah, the range of growth is 6.8 to 7.2%. If we take the average of that at 7%, and we also notice that 7% is also the medium-term growth envisaged by the economic survey in terms of India's economic growth potential. So the potential growth for the medium term and the projected growth of 7% for FY27. That is to indicate that, in fact, in official assessment, the growth that India can potentially achieve would be about 50 basis points higher than the level of 6.5% projected by the IMF for the medium term. India, as you can see on the right-hand side, is doing more than double of the global growth. So we are the star performer, and in many ways, we are in our Goldilocks moment. But now we come to the performance of the center's tax revenues. The next slide, please. And here we begin to acknowledge the appearance of a tax buoyancy which is substantially below 1 in FY26 RE, and going forward it is in fact assessed at 0.8. So that is something that one needs to look at carefully as to what is the reason. But again, we have to acknowledge that this is the reason why actually consumption expenditure expansion happened. And this is predicated upon the reforms, extensive reforms of PIT and GST reforms that were undertaken in FY26. So these two reforms were actually involved a revenue sacrifice for the government so that the disposable incomes in the hands of the households could be increased. So the two things are interlinked. And as a result, now what we see is that the tax GDP ratio has gone down. We look first at the government GI's gross tax revenues, which has gone down. Now, there is actually from FY25 a reduction that is shown in the last column, 11.5 to 11.4 to 11.2. That is a kind of limit on how much the government can finance in terms of its own expenditures. And this is also reflected in the growth rates and the buoyancy. As a result, the GTR buoyancy has now come down from 0.98 to 0.93 to 0.8. If we want, in the context of Viksit Bharat, a tax GDP ratio or an optimal tax GDP ratio, we would think that taxes should be at least showing a buoyancy of higher than 1. So in the immediate context, we have a certain constraint that is going to operate on the expansionary policies that the government of India can follow. The next slide, please. So here, one insertion, and this is what has happened. Also a very significant news in terms of the recommendations of 16th Finance Commission that have come. The 16th Finance Commission actually retained the share of states in tax devolution at 41%. So that means that when we move from gross tax revenues to net tax revenues, there is no difference as compared in FY27 as compared to FY26. So that's one implication of the recommendations of the 16th Finance Commission. The other notable features are actually that they dropped the revenue deficit grants all together, and they gave certain local body grants and national calamity grants, which when translated into in relation to GDP are only adding to 0.4% of GDP. So total transfers are 4.5% of GDP. That may actually create a very small additional space for the central government. Other than that, most of the implications of this finance commissions are horizontal in nature. That is to say, in terms of its impact on the individual states. So therefore, as luck would have it, no difference between GTR and NTR, and we can move into the budgetary arithmetic of the FY27 budget. So here we look at, this is the next slide, please. Here we look at the FY27 budget, and we move from gross tax revenues shown as percent of GDP at 11.2%, the colored column starting from the first row. 11.2, from that assignment to states remaining the same, as you notice, 3.9 between the 2 years. And that gives us a net tax revenues of 7.3. To that, we add non-tax revenues, which show a fall from 1.9 to 1.7. So two revenue side falls, 11.4 to 11.2, 1.9 to 1.7. That's a 0.4 percentage point falls. This translates into total non-debt receipts. There is some coverage, some increase in non-debt capital receipts. So the aggregate fall is only 0.2 percentage points, rounded off. Now the government shows a commitment to continue with fiscal consolidation in spite of this pressure on government's own revenues. And that is why they show that the fiscal deficit, which has been achieved in FY26 at 4.4% as budgeted, will fall, will continue to fall, although there is a slowdown in the pace of this consolidation, because earlier we achieved 40 basis points of reduction. Now it is budgeted to achieve only 10 basis points of reduction. As a result, the reduction in the debt GDP ratio also comes down. So that is one part, and this is what is leading to a fall in the total expenditure to GDP ratio from 13.9 to 13.6. It is actually a secular fall if you start from FY25. And then, therefore, although the overall size is falling, there is continued improvement in the structure of expenditure in favor of capital expenditure. And that is something positive that we can note from this. So share of capital expenditure in total expenditure continues to increase. In FY27, the ratio now is 77.2 to 22.8. About 10 years back, this ratio used to be 88 and 20 and 12. So there you can see a very important structural change in the composition of government expenditure. So now we move to the next slide, where we have a kind of consolidation roadmap, but we stop here because the government also stopped at this point in FY27. After that, what they are saying is that by FY31, we will achieve a debt GDP ratio of 50% plus minus 1% of GDP. And after that, they will go back to the FRBM targets and so on. Only point that I would like to make is the asymmetry between the phase when the fiscal deficit shot up on the left-hand side of the chart, and 2 years from a level of 0.4 to reach 9.2. And it has taken roughly 8 years to reach to 4.3, and we are not in sight of reaching back the level of 3.4% already achieved earlier, or 3%, which is the FRBM target. So the asymmetry between the two parts when we have a cyclical or economic shock is something that is the real challenge for fiscal consolidation. And government is trying to calibrate its way out of the present global economic conditions that are imposing certain constraints on us. And therefore, they are calibrating the path of fiscal adjustments. Next, we just show next slide, please. The nature of adjustment on the expenditure side. This is the main reason as to why the share of revenue expenditure has come down, which we consider as a very positive long-term adjustment in the composition of expenditure. So the share of major subsidies has come down. As a result of that, the share of revenue expenditure with GDP has also come down. Then there we have a slide on the major social sector schemes. For just half a second on this. There is a substitution of the MNREGA scheme by the Viksit Bharat G Gramin Rozgar Yojana, which we are now referring to as G Ramji, VB Ramji. And there is a substantial increase in that. That is the result of the expansion of the number of hours to be covered for employment and so on. So other changes are also marked there. Jal Jeevan Mission, very substantial increase. Gram Sadak Yojana, very substantial increase. Surya Ghar Bijli Yojana, also very substantial increase. So government is actually emphasizing welfare measures, employment, and energy sector orientation as far as the social sector schemes are concerned. So let me conclude by saying that the government is very supportive of growth in so far that it can be permitted in spite of the large tax reforms that government had executed last year. So thank you, Samir. Thank you very much.
No, thank you very much, DK sir, for distilling that. I'm just picking up questions as they're coming, and one quick question is really around what you covered on the tax buoyancy, and if you can just explain the reasons for the short buoyancy ratio, especially for FY27 of 0.8.
Well, what happened was that this is very largely due to the nature of reforms that were executed last year. PIT reforms, of course, were budgeted in the last budget, but GST reforms were brought in the middle of the year.
Right.
And what happens in these tax reforms is that rate adjustments are undertaken in the hope that as rates fall, the demand will increase and therefore the tax base will increase. Now, in the first instance, as rates are reduced, the revenue impact is immediate. The lowering of the revenue impact is immediate. Tax base picks up, but it picks up only with a lag. So we expect that over time, maybe in a horizon of 2 to 3 years, the tax base will also pick up. But the immediate rate reducing impact has already kicked in, and that is the reason why the buoyancy has gone down so sharply.
Right. So that base reset will take that much time before you can start seeing the incremental benefit coming.
Right, yes.
Okay. Thank you, DK sir. Let
Thank
me move to Gopal. I think you've been hearing through the initial part, and you've gone through the entire speech of the finance minister. Will you give me your comments, Gopal? Overall, how are you looking at it from your vantage point of the various industries that are part of your group?
Yeah, thanks for that, Samir, and thanks for the opportunity given to me today, and wonderful introduction, and also an insightful presentation by Dr. Samir Gupta, Dr. Srivatsava. So after that, I don't know, I'll have much, but let me pretend to be an economist for the next 5 minutes, and then also give my view from the industry for the next couple of minutes, so that in 5 to 7 minutes I'll wrap it. See,
Sure.
I agree with whatever that has been said. So, but if you look at the larger challenge which is there in front of the government, is to maintain the trajectory of physical deficit. And they have to keep bringing it down, like Dr. Srivatsava mentioned. So there is a pressure on that. And the second challenge that we see is that the tax receipts are not really growing up that fast as expected, primarily because indirect taxes are showing a negative growth next year, rightfully because we have shown a huge reduction in the current year. And then if you look at the non-tax revenues again, we aren't going to see that kind of a hefty dividend from RBI from the projections that have been given. I mean, I have just quickly looked at those numbers. So, given this overall challenge and also the impending pay commission that is expected next year, I don't know whether it will come or not. I think the government has got quite a bit of, fiscal management task up its hand. And then, if you look at it in that perspective, I think this budget was expected to maintain the trajectory of the country. I would say it is reformative and not transformative. Why I would say reformative is because there is quite a bit of impetus that is being given to manufacturing, and there is also quite a bit of impetus being given to future technologies. So if you look at it in terms of data centers and digital, quite a bit of allocation has been done given the overall constraints, given the overall constraints of the fiscal deficit and the revenue augmentation that will happen next year. So they have done two, three things. They've said that I'm going to give prioritization to manufacturing and to future technologies. And also they have given, a priority to a slew of other sectors. So textiles, biopharma, semiconductor, electronic components, and then of course, rare earth, this is becoming like an indirect power struggle that is happening between countries today, because rare earth consumption and dependencies is something that many countries are now deeply cognizant of. And then, of course, I did talk about chemicals and data centers. So, and then something where trade, which is actually quietly coming, which people don't notice, is the container manufacturing shop, because it's going to be very, very important in terms of sea freight and transportation and even land freight. I mean, overall, while I don't know whether they said it, but the tax, the cost of supply chain to GDP, the government is trying to kind of methodically bring it down. I know it was 3 to 4 years ago, it was 14%. They have a target of about 9.5%. And all of this, if you kind of add it up, and then you have the investments in roadways, railways, and waterways. So look at it this way: they're trying to make the country more efficient. Efficiency will bring in its own set of productivity and profitability to operations of both public and private sector. And this is one large chunk that I thought. I mean, I kind of molded it, in my own way. The second one is some set of financial reforms. Financial reforms that are coming in, I would say, is that they are reviewing the market making framework for corporate bonds and trying to bring it in tandem with what is happening on the FDI regulations. The second one is there is a TFC REC restructuring that is happening. The third one is MSME liquidity being improved through the invoicing and trades. Very important again, kind of bringing in the working capital flows inside. And MSME is one of the largest employers, as we know, in the country. The impact of some of this we'll start feeling as we go along, because one of the things, financing becomes the most important oxygen for MSMEs, as we already know. And on banking, they are looking at some changes. I couldn't gather. I think they haven't announced it, but they are trying to get the banking system even better, maybe more robust, but at the same time more efficient. And frankly, I'm like all of us. I'm a proud Indian, and I think our banking systems have kind of withstood some of the greatest shakes or upheavals that have happened in the economic environment all through the decades over the past several years. So I think again here they have kind of, if you look at it from a they have looked at the financing bit, and that is good. The third bit is the growth bit, and I did talk about transportation, infrastructure, etc. So I won't repeat it, but the 12.2 lakh crores of capex investment they have promised seems extremely credible today, because if you look at the spend that they were looking at in the current year, if my memory serves me right, it was 11.2, and they are very close to achieving that number. Of course, we'll have to get the details of the number, but I think we have seen that happening, and that incremental amount that is coming from 11.2 to 12.2, roughly about 11%, is a good number in perspective of the first statement I made. You got a fiscal boundary condition within which you will have to operate. I did touch upon the challenges. I think we'll have to figure out how the government is going to mop up the resources. So the resource mopping up efficiency of the government has to be real next year, because they're going to be tested, right? Especially so when GST has been low. I think overall, I would say that they are looking at physical consolidation, though it's a little tapered. And, the government borrowings are going to be slightly, personally, when I looked at it, but I'm not an economist. That's why I said I'll pretend to be one. But, the government borrowing seemed to be a little more expanded than I had expected. But overall, I would say that it is a good, kind of budget to keep steering the course, even as we enter new waters. That's what I would say. You're steering the course, but you're entering new waters and building capabilities. And I'm extremely happy that the focus that is happening on infrastructure and coming from, from Ashok Leyland, I'm particularly happy that there's a lot of focus on, on roads and ports and other infrastructure, because that would have a favorable outcome to our industry as well.
Thanks, Gopal. I think that is very insightful, and you gave a very comprehensive view of everything that the finance minister touched upon. And, the call out, especially on how do you build global scale and look at input cost reduction and all of the aspects around that. So thank you so much for that. There was one question before I let you go. I know that you have to quickly go away for another meeting. One of the questions that we had is, what do you feel, especially from your vantage point at the group level, about the impact of Ind AS and ICDS alignment, and how do you think this will benefit the taxpayers?
Well, at least, I believe that this is a big step, okay, because what's happening is that the government has, see, if you look at it from a trajectory of the past, what have they been doing over the years? India as an economy and as an accounting economy, or a disclosure economy, so to speak, if there is any word like that, has been trying to bring it to global standards. It is being bringing it to global standards because then understanding the financial performance of the entities as well as the country becomes easy and becomes standardized. Now, when they were doing that, they were bringing in a slew of regulations. And at that point in time, all of us did say, how many regulations do we have to comply with? And this was getting, every year was becoming more and more challenging. Now that things are becoming stabilizing, but of course, disclosures norms are increasing. And that's good in a way, because we need to have greater transparency to attract high quality capital both within India and outside India, right? But with respect to your specific question, I think this is a good thing. I see that ICDS is going to now get phased out next year, and there's no reason that you need to have multiple regulations to take care of accounting or disclosures for multiple entities. Ultimately, it would be great if we were able to actually have one set of books for everyone, but that may not happen. That could be a dream because there are differential rates, treatment of provisions, depreciation, and I know that most countries in the world have it, but I think this is a very good step.
All right, great. Thank you. Thanks for that, Gopal, and thank you for
Thank you.
joining us. Really appreciate you spending time with us.
Thank you.
So thank you for that.
Thank you very much.
All right.
Bye-bye.
So thank you so much, Gopal. Bye. Let's continue with the presentation, and we will bring in Jayesh to speak through the policy and key policy announcements and the direct tax proposals. Jayesh, over to you.
Thank you, Samir. And I think, what we'll do is that we'll cover a few of the policy announcements which are relevant for the industry. I think some of them have already been touched upon by Dr. Srivastav as well as Mr. Mahadevan, as we heard him. I think, there have been many, many announcements on the policy side. And I think, part of the speech covers a lot of that forward-looking, policy announcements. But some which really strike out. One was on the biopharma scheme with 10,000 crore outlay over 5 years to create domestic manufacturing capabilities, particularly in the biopharma and biologics, including 3 new NIPERs, as well as upgrading the 7 existing NIPERs, and looking at creating 10,000 accredited India clinical trials, sites, which I think should really augur well for the biologics and biopharma industry. Obviously, with the electronic component manufacture scheme outlay, originally when it started in April 2025, close to around 22,919 crores already been committed there. I think the scheme outlay has been increased to 40,000 crores, looking at almost the earliest scheme related outlay has been exhausted now. And there is continuing to be more and more interest in that whole area. The next one was on the container manufacturing scheme with 10,000 crore outlay over 5 years to create globally competitive container manufacturing ecosystem. And I think we did hear Mr. Madhavan touch upon this. I think there have been a lot of emphasis, even coming from the economic survey on the improvement and the process reforms on the land and logistics, particularly to help the economy, bolster forward. On the capex and infrastructure side, we have we also heard both Dr. D.K. Srivastava and Mr. Madhavan look at, the target capex, has been increased to 12.2 lakh crores for 27 compared to the 11.21 crores in the last year. This is obviously a huge, and there is also a huge structural improvement in our expenditure pattern, as we heard just now. The next one is on the dedicated REIT to set up, really accelerate the entire recycling of the significant real estate which is currently sitting in our central public sector enterprises. This will obviously unlock a lot of value and also ensure that we get the required money, which probably will also help further impetus in terms of what money will be available to be reinvested into the economy. The infrastructure and cargo movement, there are potentially freight corridors. Again, this is touching upon the land logistics reforms. 20 new waterways and coastal cargo promotion schemes. So that's the other one. The other interesting area was on city economic regions being created, and each of them will receive 5,000 crores per region over the next 5 years for modern infrastructure, amenities and facilities. And obviously, this is focused on tier 1 and 2 cities and towns and also temple towns. So obviously, it will have a spillover effect also on tourism and some of the other areas. It's been a very significant focus in the budget. The next one is on 5 university townships near major industrial corridors. And obviously, the government is looking at trying to bring the industry, skilling and other collaborations together to create the ecosystem for education, host universities, colleges, research institutions, skill centers closer to the industrial townships, so that you can create a symbiotic ecosystem where you can have some of these new skills which are required for industrialization going forward. As we move on the financial sector, interestingly, individual persons resident outside India will now be permitted to invest in listed equities through the portfolio investment scheme. And obviously, with enhanced limits, individual limits and enhanced from 5 to 10% and aggregate limits from 10 to 24%. from 10% to 24%. And obviously, the more important part is that there's going to be a comprehensive review of the entire foreign direct investment regulations, obviously to create it to be more contemporary and also to make it user friendly for the foreign investors. And this obviously augurs well for, how we're looking at attracting more FDI into the country. The next is creating, champion MSMEs. The equity support of close to around 10,000 crores. Plus, I think what we heard Mr. Mahadevan talk about, the additional funding through TREDs and other things, for the SMEs. This obviously will be the, create the future champions, bring them up, scale them up. The more interesting part also we saw is that, professional institutes will be allowed to design shorter term modular courses to create somewhat what they call corporate mitras in the tier 2 and 3 towns for accounting paraprofessionals, to be accredited paraprofessionals to be able to help these MSMEs and SMEs meet the compliance requirements. So these are a few of the policy announcements, Samir, and I think maybe we can
Yeah,
move
I,
on to
I,
the.
I think of all the announcements, obviously the REITs is a pretty interesting one because, both REITs and InvITs have crossed 10 lakh crores of AUM in, about 8 years. So that's fantastic. So I think that's probably one which will get a lot of attention.
Yes, yes, sure. Moving on to some of the tax related proposals. And interestingly, we have the new Income Tax Act of 2025, which comes into force on 1st of April 26. And I think that's one very clear policy announcement which government already made, and they've emphasized and re-emphasized the same in this budget. And as we've seen, most of the proposals in the budget which have been announced have been aligned with keeping in view the 2025 Act. So I think largely all the announcements are more forward looking. And, in terms of looking at really how we implement the new law with the very tenet of trying to improve the ease of doing business. I'll come into some of the individual tax proposals. So as we look at some of the new age industries which the country is actually trying to promote, which includes the electronic component manufacturing, the PLI, and the ISM, the semiconductor mission, it has been seen that the talent which is required to really give the impetus and give the growth momentum to this particular industry is that literally not available in the country, and therefore to attract the global talent into India. There's a tax exemption proposed for non-resident individuals on their foreign income. So first of all, these individuals have to be non-resident for at least 5 years before they come into the country. And once they come into the country for the next 5 consecutive tax years, their foreign income, which is otherwise not deemed to accrue or arise in India, will be exempt from tax. Now, generally speaking, any non-resident who's not been a resident, never come to India, literally for the first 5 years when it comes into India, he generally becomes a RNOR for the first few years. So typically he would enjoy the same benefit, but I think extending it to 5 years really gives certainty that for 5 years, a reasonably long period of time, they will not be subject to tax on the foreign source income. Obviously, the scheme is yet to be notified by the government, and we yet to see the details. Simplified TDS compliance for resident buyers of property from non-residents. So what happens when any resident is buying a property from a non-resident in India? The resident needs to comply with the withholding obligations. He needs to do the TDS. But while doing the TDS, while from buying from residents, there was a PAN-based system so that you don't have to take a tax deduction account number. Now, the similar benefit has been also advanced to resident individuals buying properties from non-resident sellers. This will be effective October 1, 2026. There's a clarification on sovereign gold bonds investments. Now, this is a little bit of going back, but exemption on capital gains in respect of income arising on redemption of sovereign gold bonds is now available only for original subscribers and not for secondary buyers. So if people have bought SGBs from the market, then they'll be subject to tax either if they sell them before they redeem, or even on redemption, they'll be subject to tax as capital gains. Moving on. This is interesting that I think what has been seen is that government has, through this whole exchange of information, noticed significant amount of error in disclosures by a lot of small taxpayers. So they, particularly on their foreign income and foreign assets, and some of that can be inadvertent, some of them can be small change, but obviously that opens them up for exposure both on the Black Money Act and also on the income tax law side. So the government is proposing a foreign small taxpayers disclosure scheme, which will be The scheme has yet to be notified, but this window will facilitate voluntary compliance of undisclosed foreign assets and or foreign income, and with the additional tax payment or a fee payment that will be regularized, and this will give them immunity from penalty and protection and prosecution. We'll wait for the scheme to be notified, but I'm sure this will have good uptick in terms of some of the individuals who may have failed in reporting this just out of oversight, or some income they have or some bank account they have overseas. They would like to come clean and ensure that they don't they don't have an issue on penalty and prosecution going forward. This is another interesting aspect that, and this was the ask of the industry, both on the TCS and TDS front, that, the rates need to be rationalized. So rates have been rationalized. I'll not go into too much of details here, but on the LRS scheme, whatever remittances were made earlier were subject to a 5% for education or medical treatment and 20% for other than education medical treatment. Now they've introduced a 2% for education and medical treatment, and 20% for purposes other than education or medical. So I think there's a reduction in the rate of TCS. Similarly, so sale of overseas two programs packages, the reduction is rate from 5% to 2% overall. So I think this is a very positive in terms of, some of the proposals on TCS, because this was significant amount of tax being collected, but at the same time, there was a lot of refund also, which was then becoming due because of the amount of taxes collected. Moving on, there have been a few announcements on trying to attract global investments, particularly on the data center side. And we've seen a lot of interest recently, and some very, very significant announcements were made on data center, where foreign investors are coming into the country. So it is proposed to provide a tax holiday up to 31st of March 2047 for a foreign company on any income accrued arising in India or deemed to accrue in India by way of procuring data center services from a specified data center. And obviously, the scheme and other notifications have to come. But what it means, so on the flip side, it does mean that it tries to create a point of certainty, because we've seen in the past that there have been debate around the fact that if there are assets which are controlled by foreign companies, so if there's an asset in India or a machine in India which is controlled by a foreign company, or then there's a potential for a tax litigation or a concern by virtue of business connection of PE. So but at least now it has been clarified that all the way up to 2047, a foreign company which is sourcing data center services, because in a typical data center, the data center is generally under the control of the foreign company, because that's how the industry operates. And they're saying that there'll be a complete tax, exemption on tax holiday on the same. But it has been proposed that the services to an Indian user will have to be done to an Indian reseller. And I'll come further down when they've also provided that if the foreign company and the Indian data center provider are related parties, they've also provided a safe harbor threshold of 15%. And we'll cover that when we come to the safe harbors.
Just to be clear, Jayesh, the Indian data center will provide the services, and in that sense, will be subject to tax. It is in the context of the
foreign company.
footprint of the overseas entity that there's full clarity now that
Yes.
that will get a tax holiday, so that there is no further taxation in India.
Yes. And you're right, Samir. I think this has its roots in the earlier tax issues which is seen in the case of ticketing companies for airlines and others in terms of credit card companies. So I think they have acted in I would say acted in advance to ensure that a similar issue doesn't really hanker and concern the companies who are setting up some significant investments in the country. So a very positive move to that extent. You're absolutely right. On the manufacturing of electronic goods, similar to so there's a proposal to provide exemption for foreign company providing capital goods and equipment, something similar to the previous one, where if they're capital goods and equipments and tools which are provided by a foreign company, which is actually the principal manufacturer, to say a contract manufacturer in the country. There was always an issue whether that, because of the ownership of the capital goods and equipments and tools is with the foreign company, and also, but has to be under the controlled direction of the contract manufacturer in India, whether that creates again an extension of the foreign company into the country. So they have provided an exemption that will not be an exemption available up to 2030, 31. So this was also an ask of the industry, where I think we've seen, particularly in the ECM and the ISM space, where the industry participants had actually approached the government saying that they need clarity, because there are some very, very complex equipments which are required specifically for such kind of manufacturing, and when they are provided, does it create a tax exposure for the foreign company in India? And I think this obviously again augurs well for this particular sector, and will clarify issues and ensure that there's more clarity in terms of future moving forward. Uh, on the IFSC side, I would say this is a very significant announcement in terms of trying to give, a significant long-term clarity on tax exemption. So currently, 100% tax holiday is available for offshore banking units for 10 consecutive years, and all other units in the IFSC are eligible for a 10 consecutive year out of 15 years. This is a 100% tax holiday. And obviously, for non-tax holiday period, taxes are levied at the applicable rates in force. Now, the proposal is that for offshore banking units, the tax holiday period is proposed to be extended to 20 consecutive years. For all other units in the IFSC, the tax holiday period is proposed to be extended to 20 out of 25 years. Now, this is a significant, almost a double leap. And for non-tax holiday period, the tax on eligible income shall be 15%. So now I would say the 15% kind of aligns with the Pillar 2 threshold. And to that extent, this, makes the entire, IFSC ecosystem very compliant with our global taxes. At the same time, it gives a very, very significantly long-term visibility in terms of how taxes will play out. Now,
So again,
obviously, the
this
unit.
is, sorry, I was just saying, Jayesh, that this is again a pretty fundamental ask, just to ensure that, when people are committing to set up presence in IFSCA and moving it, especially from other jurisdictions like Singapore or from Dubai,
Yes.
that they get a longish view with respect to getting, some of the benefits that they are already enjoying in those other jurisdictions. So again, very progressive.
Progressive, as well as obviously puts it in a very competitive landscape now.
Yes.
And obviously the unit has to be set up after 1st April. And, the splitting up or reconstruction, reorganization related provisions were not there in the previous law, but I think they brought it in because having extended this, they would actually want to ensure that there's, anti-avoidance rules are there in the IFSC regulations as well. Moving on. Uh, this is another very, very interesting and a big, big positive, because this was asked of the industry that the safe harbor rules under transfer pricing provisions needed a significant relook because of the experience over so many years of transfer pricing, plus some of the large, the GCCs really actually are the global capability centers or R&D centers that actually scaled significantly. So I think they were falling outside the purview of the safe harbor rules. So the current software development, ITS, knowledge, KPO, and contract R&D services are considered in separate categories with differing safe harbor margins. They range from 17 all the way up to 24%. Now, all these services are proposed to be clubbed under a single category of IT services with a common safe harbor margin of 15.5%. And the threshold for availing also has been significantly enhanced from 300 crores to 2,000 crores. Now, this is a huge positive. And as I mentioned, even for data center services, they're now eligible to get coverage under safe harbor margin of 15%. The effective dates, amendments, all these are awaited, but a huge positive announcement, and I'm sure it'll augur well for the services sector, particularly the GCC and the services sector, which currently accounts for almost 3 to 4% of our GDP.
I think it takes away a lot of friction that is there today in terms of, categorizing the services, and therefore, are you subject to, the different higher end rate of KPO, for example, right? And secondly, I think, the threshold ask again means that, this will be equally applicable to pretty large and decent sized FTs, captive centers as well. So again, a very positive step.
And as you said, Samir, I think this actually kind of, hits a problem with multiple, it's one bird with multiple, it's kind of multiple birds with one stone, as I were to say, because already we have seen capacity constraints in terms of APAs. So I think if,
Yes.
the APA load will actually be reduced to a certain extent. Having said that, at the same time, we'll have to also look at the details here, because the APAs, there are a lot of, detailed conditions which are applied. I don't know how they will reflect in the safe harbors, and we'll see how those will therefore become applicable and available for, existing APAs which are there. Typically, an existing APA takes around 2-3 years for conclusion, and therefore you're almost in the third or fourth year of your APA period by the time you get to a conclusion. So you're left with a couple of years. I'm sure the current APA propositions which are laid out, they will also reevaluate. At the same time, I think, the existing APAs will have to be also reevaluated to see that how this, safe harbors really make sense for them.
No, absolutely. And interestingly, many economies like the US are questioning the large payouts that go into countries like India, right? So while this may be true from a SHR point of view, but perhaps it also gives them the ability to negotiate something lower than this in a bilateral. And that is
Yes.
something which will always be, something that clients should think about.
Yeah. I'm only concerned a little bit, and I think we'll see how it goes, that if suppose an APA bilateral had agreed a higher rate than 15 and a half, then,
Like that's
how
something
this will
we,
position. So we'll see how it positions at
yes.
some stage. One another interesting factors on the unilateral APS for at least IT services companies. Currently, there's no prescribed time limit for conclusion of the APS. For the IT services, it will be fast tracked to be concluded within 2 years and extendable for 6 months at the behest of the taxpayer. So this is again a significantly positive move in terms of getting unilateral agreements on, advanced pricing agreements. Going forward, this was another ask of the industry that when an APA was concluded, the modified return was filed by there was an ability to file the modified return by the APA applicant, which is the Indian company, but the associated enterprises was not eligible to file a modified return. And according to the corresponding adjustment, and the other, whether if excess taxes were paid, they were not able to actually find a mechanism to actually deal with that. This amendment obviously will allow an associate enterprise also to file a modified return in accordance with the APA agreement and either claim refund of any of the excess taxes paid. So this is a very positive move, and obviously this was an ask for a very significantly long time. And this will is signed on, so it will be applicable for every agreement signed on or after 1st April 26, and will apply for the tax year 26-27 onwards. So there have been a few changes which this budget has proposed, which are trying to address some of the current existing controversies in the courts. And I'll come to them, in the next and onwards. So there's a current controversy going on in terms of different interpretations whether the final assessment of the past pursuant to a dispute resolution panel direction must fit within the overall time limits of the completion of assessment. Now, there's obviously a typical conflict between the section 143 and 153 and 144C in the old law. Now it is clarified the time limits mentioned for completion of assessment governs only the draft assessment order, and therefore this amendment obviously is a retrospective amendment, effect from 1st October 2009 in such cases and 1st April 2009 in other cases. So this will, to a certain extent, I would say, clarify the positions, which are held out, and to that extent, some of those litigations will probably no longer stand in the courts. Obviously, the way some of these amendments have been written can cause for further concern, but at least the government has very clearly laid out what their intent is in terms of how this law should be read. Moving on. Again, this is the other one where I think there were divergent high court rulings on whether the NFAC versus assessment units can issue notices and pre-assessment inquiries. Now, it is clarified that the jurisdiction assessing officer can issue notices. Earlier, courts had held that it's only the national, the faceless which was able to issue, but that issue also has been clarified. And again, this is a retrospective amendment, effect from 1st April 2021. The next one was on DIN-related mistakes. So I think we've seen a lot of orders being passed and it's issued with DIN coming only in the last page. And obviously, by virtue of the government's own admission, there's that DIN has to be on each and every page. So various high courts have held assessments as invalid due to non-quoting of DIN on every page of the assessment order, the body of the order. It is clarified that this invalidity cannot, completely invalidate the order. Merely due to any mistake and defect, omission, or DIN. As long as the assessment is referenced by the DIN in any manner, it should be fine. Again, this is a retrospective amendment effective 1st October 2019. One another very, very important change in this year again is, so currently, as we know, the buyback is taxed as deemed dividend in the hands of the recipient shareholders with an entitlement of capital loss on the cost of shares which are bought back. Now it is proposed to provide that capital gains treatment to buyback. And I say we are going back to a, position couple of years, couple of times back. So I think, as we know, this capital gains buyback has actually gone through a significant number of changes over a period of time. The only change here is that while they're saying buyback will be taxed as capital gains, but for promoters, uh, and promoters are defined to hold directly or indirectly more than 10% shareholding, or as per SEBI listed companies act unlisted. Additional tax will be levied to equate it to regular tax rates, which is 22% for a domestic promoter company and 30% for other promoters for long-term capital gains. So I think what government is trying to, and they made it very clear in the speech also that they actually don't want promoters to leverage a buyback, but they are willing to have the other shareholders, non-promoter shareholders, to have the same treatment as the capital gains. I think this is a very positive. It was a ask of the industry, and at least for listed companies, it will open up doors to return excess capital back to the shareholders. And the tax obviously will be not a deterrent in trying to do that, because I wouldn't think that, in my view, capital gains is the only way you can treat a buyback, and not necessarily the other ways. So I think this is a very, very positive move, Samir.
No, of course, I mean, I agree with you, and they've brought in this anti-avoidance measure. But
Yeah.
as we know, there are several professionally run companies which may have promoters, correct, who follow all the corporate governance and may still do the buyback. So in that sense, it may hurt some of those situations.
Yes, it may still. So I think it still does not address the that category. Absolutely right. So there's been some increase in the STT rates on derivatives. So STT transactions, currently prescribe 0.1% on sale of options premium and 0.125% sale on exercised options, and 0.02% sale of futures and securities. Now the rates are proposed to be 0.15% on options premium, 0.15% on sale of exercised options, intrinsic value, and 0.05% sale of futures and securities, to address excessive speculation in the derivatives market. And I think we've seen that, we were almost expecting this, because I've heard this, that there will be something coming on this because of the significant excessive derivatives trading, which is, and it's across individuals and everybody. So moving forward. So this is, so currently a deduction is allowed under income from other sources towards remuneration, commission, or interest expenditure with a cap of 20% that is incurred on earning dividend income. And as we all know, dividend income by virtue of fiction is taxed only under income from other sources. Now, this expenditure, which was allowable subject to a cap of 20%, has now been completely removed. So I think this deduction will not be available. So dividends typically will now be taxed on gross basis without any allowance for any deduction on this count. Time limit for passing of transfer order. Now, this is again a controversy which is brewing, that whether the 60-day period for transfer order, the courts had ruled that the final date of limitation, whether it's to be excluded or not, because the order of transferring needs to be passed 60 days, 60 days before the final order is passed. So I think whether that 60-day period included the final limitation or not was a controversy, and I think courts had held that don't have to. But I think they have now clarified that the 60-day period shall be computed by including the date of limitation for consistency and to reduce litigation. And again, retrospective amendment 1st June 2007. So I think we've got some 4 high court rulings, which are almost at the threshold of entering Supreme Court, have been kind of clarified by virtue of retrospective amendment. So we'll see how this plays out. Obviously, we'll have to see what happens to a lot of the cases which are pending at the courts and where stays have been granted, so how they will actually come into effect. So I think there'll be a lot of work to do to ensure that some of that stuff is actually rationalized, cleared, and settled earlier than later.
I think the point, even the ASG put out something to really say that,
Yes.
the substantive issues should be dealt with,
Yes.
and and cases shouldn't be, barred simply because at the threshold level there is some inconsistency.
Yes.
So I think that's the underlying principle across all of them.
Yes. And I think this is also, as you rightly said, there's also actually kind of expressing the sentiment the government will take going forward on issues of this nature.
Yeah, correct.
There's some further measures on critical minerals, because they added critical minerals in the schedule for allowing deduction of expenses incurred for prospecting and extraction and production of minerals. So minerals like glauconite, graphite, potash have been included in the schedule. So some of these expenses will be eligible for claiming. This was another ruling which I think on the positive side, it has been done for the taxpayer. So currently, employee contributions related to employee welfare is deductible if deposited only within the statutory due date under the relevant act or rules. Now, there's a ruling of the Supreme Court in the case of checkmate. Now, obviously, they have said that the deduction shall be allowed if the payment is made till the due date of filing the return of income. A very positive move, because there could be genuine reasons and industry was actually clamoring for this and they requested as a positive, development to allow the deduction till the return filing. Moving on. So due dates of filing of return of income, at least in the case of SSCs having business income, but they're not required to be audited, they've extended this by a month from 31st July to 31st August. And time limit for filing a revised return has been extended from 9 months to 12 months from the end of the relevant tax year for all the taxpayers subject to a fee of 1,000 or 5,000 rupees. And this amendment will apply from the tax year 25-26. So effectively the current year itself is, I think, the challenge was that the revised return and the belated return, actually they were all coming onto the same date. So I think there was no ability to actually file a revised return because they were all falling on December. So now I think at least 3 more months have been added for filing those revised returns. Filing updated return after issuance of reassessment notice. This is again a very positive move. Currently, updated returns allowed to be filed up to 48 months from the end of the financial year with additional payment of taxes provided no reassessment notice is issued. Now it is proposed to allow filing updated return even after issue of reassessment notice, subject to payment of 10% additional tax. Now, this again will ensure that if there is a reassessment where the taxpayer believes that he wants to settle, this is almost like, in a way, if a taxpayer believes that through reassessment he needs to settle something, I would say a kind of a settlement commission, settlement option available for him to admit to it and actually pay additional tax and actually move on. So again, a positive move, hopefully reduces controversy litigation moving forward.
No, absolutely. I think this is a very positive one. I agree.
So so there was a question around MAT applicability under presumptive taxation for non-residents. Certain foreign companies were excluded from application of MAT currently. But to ensure uniform treatment, it is proposed to exclude 2 additional specified business of non-residents from MAT, operation of cruise ships, and I think more important part of the provision of services or technology for setting up ECM, electronic manufacturing facility in India. I think, this obviously the presumptive tax came in, but, MAT exclusion had to be there. So this MAT exclusion should obviously help. It is proposed that MAT, so there are changes on the MAT. In fact, there are changes on the MAT provisions aligning with the tax regime. So it is proposed that the MAT rate will be reduced to 40% from the existing 15%. And it is also proposed that tax paid under the MAT provisions be made final tax in the old regime and no new MAT credit may be allowed. So effectively, no MAT credit if you continue to be in the old regime. So you will have to pay the final MAT tax if at all, and that becomes your final tax. But the credit between the normal tax and the MAT tax, which was generally available to you, there's no further credit available. And so for domestic companies under the new regime on or after 1st April 26, the MAT credit which is available can be set off to the extent of 25% of the tax liability. So they are moving the MAT credit into the new regime and saying that you are eligible to carry it forward and also utilize it subject to a limit of 25% of the overall tax liability. And obviously they're adjusting, if the income gets adjusted upwards or downwards, that 25% also can be adjusted upward downwards. For foreign companies, set off is proposed also to be allowed up to the difference between tax and total income in MAT. So I think positive move, but a very clear indication that government wants to phase out the old regime and wants everybody, all corporates, to basically align to a MAT regime of, the new current regime of 22% in tax and allowing the phase out of MAT credit available till date. So this is obviously a change in terms of directional change with the government proposes to enhance going forward.
Absolutely. And I think over here, companies will have to evaluate, depending on what stage of life cycle they are. to the extent that you are at the end stage and you have significant MAT credit balances, then you may have to do that simulation to see what does it mean
How
if
it
you
does.
if you want to move to the new regime. So some work to be done there to finally take a call. But the
Yes.
direction of travel is just like in personal income taxes. They have nudged everyone to move to concessional tax regime now, right? Similarly, over here also the act is to clean it up in terms of the MAT
Yeah.
credits.
And nudge, Samir, has a very different connotation in income tax.
I agree.
Okay, moving on. So I think there are significant other rationalizing measures which have been announced. It is now proposed, particularly in penalty, a single composite assessment in penalty order, with interest deferred till the first appellate outcome. Now, the government has proposed this as a rationalizing measure because they said, both the proceedings under the normal assessment and the penalty proceedings actually dual proceedings. They kind of include, therefore they are causing multiplicity of proceedings, and they have said that everything will be composite. But I'm not sure how the industry will take it because effectively they've also reduced the tax payment on the first appeal from 20% to 10%, but now the base increases. So I don't know whether under the overall base increase of including penalty, whether a 10% versus a 20% on the original normal tax would differ on how it will hit the cash flows. Now, presently, immunity from penalty is provided for underreporting of income, which is now extended to case of misreporting of income, subject to payment of additional tax of 100% tax on misreported income and 120% in case of unexplained income. So while they have brought in everything in terms of numerical thing, but composite assessment order, including penalty, you'll have to continue to argue both the merit as well as on penalty at the same time as you go ahead. So I think this really needs to be seen how this will play out. There was at least in the earlier regime, there was at least a suspension of application of penalty assessment, and therefore the intent willfulness mens rea was not subject to question. But I think at the very threshold of assessment now, the assessing officer needs to make that determination. I'm not sure whether the assessing officer will ever take a judgment call to say that these things are not subject to penalty. So I personally think that this might probably increase the amount of tax demand that the taxpayer will have to deal with in the case of an assessment which has an adjustment, where the quantum actually just kind of bulges up. But I think we'll have to see whether this will yield the positive results as expected in terms of reducing the amount of controversy at the threshold by reducing the multiplicity of proceedings. Uh, so, penalty for failure to furnish Form 3CB. Currently, failure to furnish 3CB attracts a penalty of 100,000 rupees. Now, proposed to levy a graded fee of 50,000 for delay up to 1 month and 100,000 thereafter. Now, this is interesting to say that the penalty has been translated into a fee. So, I think the discretionary aspect probably goes away. It's just a fee which you have to pay to regularize stuff. Uh, Electronic verification of issuance of lower or nil withholding certificate in case of small taxpayers. The scheme is yet to be announced, but this is a very positive move in terms of making an application online and the assessing officer online approves the same thing for you. Manpower supply was actually whether it comes in the ambit of work. There was always a debate, and thereby clarified that it will attract TDS at the rate of 1 or 2% depending on whether it's individual HF or others. Scope of filing updated return expanded to allow cases relating to reduction of losses. This was an issue because updated return was allowed only if there was an additional tax payable, but if a loss was to be reduced to a lower loss, whether you had the eligibility to file, that was not very clear. So this has been also changed. So it is now proposed to have a single composite assessment. Oh, sorry, go forward. Next slide, please. I
Yeah.
think this brings me to a close, Samir.
No, that's great, Jayesh. Obviously, there's a lot that's come on tax certainty, as well as the entire procedural aspects, TDS and decriminalization also. So I think there's a lot that has been
Lot more.
covered there. I've
Yes.
got one question already, which I thought I can, and this is more on buyback. That with the change in treatment for buyback, do you think buybacks are now a good mode to provide exit to shareholders?
Public shareholders, yes, Samir, for sure.
Yeah.
But to the promoters, I'm sure it'll be a high yield tax. So that may not really work for. But if there is a consolidation and return of money to the public shareholders, yes, this surely brings back the old verb in the buyback. So I think buyback had lost its complete steam after the treatment as dividend came in. So I think this will surely be a positive move.
Yeah. No, agreed. Okay, so let's move on to Uday for covering the indirect tax proposals. Uday?
Thanks, Samir. We'll quickly go to the first slide. Yeah. So the customs proposals are in line with, by and large, what the expectations were, and the entire customs policy for the last few years has been fairly consistent. For the last few years, the policymakers have acknowledged that the decisions related to tariff are primarily to deal with simplification of the tariff structure, supporting economic activity within India, primarily domestic manufacturing, promoting export, and reducing any cascading impact on account of duty inversion, and not so much to do with revenue implications. I mean, in fact, if you go to see the customs duty collections, primarily related to basic customs duties, have by and large remained very, very similar to what they were prior to, I mean, since the inception of GST. And the weightage or the overall weightage in the overall tax collections, indirect and direct tax collection and customs, has actually kept on reducing. So now it's more a policy issue, not a revenue issue. And I think this particular uh, 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 finance bill also continues with that policy. So primarily, what have they done? They have, as in the past, tweaked with exemptions and driven by tariff simplification and some of the other pillars that I mentioned. So there are about 124 conditional exemptions in the law, in the general exemption category, out of which, by and large, most of them have been extended to 31st March 2028. So sometime back, about 4 years back, 5 years back now, the government had included a legislation whereby most conditional exemptions had a validity period of 2 years, mandating the government to kind of relook at or reconsider the very validity of these exemptions every 2 years, go to speak. And by and large, they have extended exemptions, but also have taken conscious calls to lapse some of them. So there are about 22 entries where the exemptions have been lapsed. 102 have been extended, and about entries, the sunset clause of these 2 years, okay, has actually been removed, primarily to do with parts for manufacture of telecom equipment and parts in relation to vessels, that vessel manufacturing or vessel repair. Those are the things that they have kind of granted now an exemption with a lot more certainty for time immemorial. So that we are seeing. A lot of other reduction alignment of basic customs duty has been driven by to support domestic manufacturing and value addition, primarily critical minerals, strategic raw materials. Have the duty rates have been kind of made more benign, as in the case of in the past, several drugs and treatment, life-saving drugs and cancer treatment drugs, the duty rates have been exempted. So is the case for electronic parts, EVs, and battery storage, where some bit of PMP and PLI alignment we've seen happening. Going to the next slide. The bulk of the proposals incrementally have been to do with trade facilitation. And the trade facilitation has several elements to it when they've looked at it. One is to provide certainty and reduce ambiguities or disputes. Okay, and part of it has also kind of come about from the customs tariff movement. Part of it has come about by these legislative changes that have been proposed. Part of it has been kind of proposed by way of sheer facilitation with the trade. On that count, the validity of advance rulings earlier was for 3 years. Now it's been extended to 5 years. This was an ask of the industry. Most forums, industry forums asked for it, and they have kind of acquiesced and kind of made that happen. They've made that amendment. And hopefully that should help. There is one more element that clarity hopefully will come about renewal of these advanced rulings as we go along, and some facility on that. The second bit that they have gone ahead and done is allowed a deferred customs duty payment cycle. Earlier, it was for AEOs, Tier 2 and Tier 3 AEOs could pay duty once in 15 days. That period has been extended to a month now. It's now, in a sense, broadly aligned with how one pays GST as we go along. So for Tier 2, Tier 3. But more importantly, a similar duty deferral facility is also proposed to be extended to eligible manufacturer importer. And that's great. The eligible importer, manufacturer importer would need to kind of go back, make an application to the Directorate of International Customs, and then kind of get this particular facility extended to itself. And that's a very, very good kind of proposal that has come about. The third bullet kind of talks about, again, a trust-based system being implemented for movement of warehouse goods between bonded warehouses. This is going to be very, very good for a lot of logistics movements, but also for SEZs or other kind of bonded warehouses, as we kind of call it. This is going to be kind of implemented by amending Section 67 of the customs legislation. Now, the key element in this is that you don't need to now necessarily go for a prior approval from a customs person for kind of these movements. They are going to go about specifying procedures, but that particular prior requirement or prior approval has been removed. Several trust-based measures have been kind of talked about. The overall system, I mean, the key theme of this budget is the transition from a control-based administration to a trust-based systems. The budget reinforces the government's continued shift towards a trust-based governance, where compliance facilitation replaces control, and responsible taxpayers are being trusted and are being treated differentially to reduce friction, minimize intervention, which can, I mean, create discretionary kind of events with the department, and give certainty to importers and exporters as we go along. And the assessments from now on are going to be driven by technology, risk-based assessments, and AI being used as we go along. So that, I think, is again a very, very good kind of proposals or direction that the government is kind of moving towards. Baggage regulations are being replaced. New baggage regulations are kind of being proposed. Duty rates for baggage has been reduced from 20% to 10% effectively. And a lot of these regulations are intended to kind of remove any ambiguity and provide clarity for people who come in. And again, a very good move that the current limit for allowing courier exports was 10 lakh rupees. But in support of MSMEs, that also has been kind of, that threshold has been removed as we go along. Special economic zones, um, there has been an announcement whereby special economic zones as a one-time facilitative measure are going to be allowed to be, sold goods in DTA at concessional duty rates. And we'll see the fine print as we go along. So that's on the customs proposals. On the GST one, the budget is obviously an avenue for primarily driving the proposals agreed upon by the GST Council. The 3 or 4 proposals that we had seen proposed by the 56 GST Council are now getting implemented. One was obviously the deletion of the uh, the requirement of intermediary services being where the service provider is. That particular provision under the GST law in the IGST has been deleted. It's a hugely beneficial impact, especially on export kind of activity. A lot of, controversy, hopefully for the future, can be addressed. The date of implementation of this particular change, one would need to see what that date would be, primarily by the enactment itself. It's possible that this amendment could be made effective, but in the past, this date has been defined in the Finance Act as a date to be notified. So we'll see where that goes.
So, Uday, just quickly on this,
Yeah.
of course, this is, a pretty significant one, both for people who are exporting as well as on the import side, from a reverse consumption point of view. So I think it resets the equation. But what happens to the past cases where there are disputes?
So the past cases, unfortunately, this amendment is not retrospective. This amendment is prospective. The past cases, hopefully, with this should see resolution slightly happening more faster than what we had seen in the past. But this amendment is prospective, so it doesn't really impact anything in the past or past litigation, so to speak. Okay. So quickly moving ahead, post-sale discount. There was an amendment that was proposed by the GST Council in Section 15, whereby the linkage with the terms of agreement and discount were required to be shown. Now, even post-sale discounts will be allowed to be reduced from the taxable turnover and reduce the GST. Relevant amendments have been made in Section 34 about issuance of Credit Note 2. Again, this is also somewhat related to the proposed IMS, system that should see the light of day at some time in the future. On the GST refunds cases, IDS provisional sanction of refund for 90% for IDS refunds was proposed to be extended. That amendment has been brought about. It will be brought about obviously by the amendment as will come, but the government had promised to kind of start allowing provisional sanctions and faster refunds even earlier. And we've seen some bit of that activity happening in the past. On the National Appellate Authority of Advance Ruling, in the GST Council, primarily, there was a decision to be taken whether a separate National Appellate Authority of Advance Ruling should be established, or should it be given to the principal bench of the GST tribunal. I think a decision appears to be taken basis with the amendment that we've seen, that a separate NAAR will be constituted, but in the interim, probably the principal bench would be allowed to kind of hear these. These are basically disputes wherein for the same person, for the same issue, there are divergent advance rulings from the two different states or otherwise. And the National Appellate Authority is supposed to resolve that as we go along. So that's on the GST proposals, Samir. I think we're done with the indirect tax.
Yeah, thanks a lot. I know we've covered a lot. We just have a few minutes. I'll just try and take a couple of questions which have come in. One, if I can get Jayesh to look at this. The question is, can you provide a perspective of how the transfer pricing safe harbor proposal will translate for taxpayers who've already signed APAs? So if you can just throw some light on that, Jayesh.
Thanks, Samir. I think a very interesting question. I think concluded APAs, whether we can actually come out of the APAs will become a question now. But I think what will be important will be to actually look at the fine print of how safe harbor provisions are notified. Because under an APA provision, there are multiple things which, under an APA, there are multiple things which actually becomes conditions, whether free of cost tools, ESOP cost, and how do they get dealt with. And therefore, while we look at a 15% or a 15.5% as a very moderate rate, whereas we've seen that some of the conclusions under the APA have been at higher than that rate. But in context, we'll have to see once the safe harbor provisions come. So I think this will be a point to really evaluate as we go along. But clearly, I don't think, we'll have, unless we look at the fine print, we actually come to a conclusion whether the APA result was the right result or not. I also see a challenge that if the conclusion is that 15.5 safe harbor is better than the APA result, then in a bilateral, how the US Competition Authority will actually start thinking about it is also a question, right? So, it's a very interesting question. We'll have to see how it comes about, and then we'll have to case specific devise the strategies to move around this.
No, I agree. I mean, while conceptually it is a very bold move, but it all comes down to, fact specifics as well as conditionalities that are attached to see, whether that is something that it's a low picking or you will have to, deal with the details.
Yes.
So you're right. Uday, there is one question which is on the SEZ relaxations. And this is really, asking around the impact of the proposed SEZ relaxations for DTA sales.
Yeah. Samir, on that, we'll need to see the fine print as and when it comes. But broadly speaking, there are two avenues in which the industry was asking for, and it's great that this proposal has kind of come about. The industry has been asking that to promote economic activity within the country. It's given that there are FTAs getting executed. The best possible kind of, let's say, duty regime should also be allowed for investments that happen within the country, especially in an SEZ, which are in a sense de facto. I mean, the logic goes that anyway they are foreign territory, and it should be kind of allowed. And there is second bit that was being kind of asked for, that the SEZ should be given a similar kind of treatment as in the case of other schemes such as the mover, whereby you're not kind of imposing a duty on the final product value, but on the duty foregone when the product kind of gets moved to the DTA. I suspect basis what has been mentioned in the budget speech of the Honorable Finance Minister, it might be the first one, but I think we'll need to see the final print as to how this will pan out. But it's very, very interesting and a very, very positive move, as we see.
And just one more thing, customs amnesty. I know you spoke about, 4 pillars and how they've addressed some of the concerns, but on customs amnesty, which was a big call out, we didn't hear anything.
Yeah, I mean, the logic for that ask from the industry was that the customs litigation in the recent past has significantly increased.
Yes.
There was a Rajya Sabha question sometime in June last year, where it suggested that over the last year, the number of disputes had increased by 20% in just 1 year, but the value of disputes has actually gone up by 80%. Now, the value of disputes customs duty is around 94,000 crores. And that's why, and it's kind of increased from 15 crores the year earlier. And that's why there was some merit in kind of looking at kind of providing certainty and going through this. Hopefully, we'll see some light of the day, maybe in the near future on that one. I think a similar thing should also be seen for the GST perspective also.
So thanks for that. Thanks for that, Uday. So friends, this is as much as we had time for. We are at the end of our 90 minutes webcast, and I know we have covered a lot. But in summary, one can say that, there was a lot that got dealt out, especially in the pieces that was covered both by Uday and Jayesh. There is a lot of detailing that we still need to see, whether it is the safe harbor regime, whether, it is on the SEZ part. So we'll need to wait for some of that. And clearly, in terms of choosing between MAT regimes, simulations, so there's a lot of work that needs to go into strategizing how some of these proposals will actually impact the businesses. From a overall perspective, as DK sir said, GDP growth with a 7% median for 27, as well as from a medium term point of view, if we need to continue on the 7% growth path, then from a go forward point of view, we will still need to have much more focused deregulation as well as further structural reforms. So let's see how all of that pans out. Please reach out to any of your EY partners for any further advice, as well as any questions or queries that you may have. And we will try and respond to other queries that we were not able to pick up in our wrap up session. Thank you very much for joining. It's a pleasure to have you. It's a Sunday, and we're really happy. We had close to about 1,000 people join us today, which is fantastic. And thank you to all my fellow panelists. Gopal joining from outside, who's left now, but thank you very much. Thank you, Uday, Dr. Srivastav, and Jayesh.
Thank you. Thanks, Selva.
Thank you.